Let's talk about something that happens on every single trade you make. There's this hidden cost, this little bit of money that just vanishes from your account. And we're going to pull back the curtain on it, figure out where it's going, and more importantly, how you can stop the leak. You see a price you like, you hit the button, and boom, the shares pop up in your account. Simple, right? But what actually goes on in those few milliseconds between your click and that confirmation screen? Well, that's where the real story begins. And this isn't some small detail, you know? This is one of those fundamental things that really separates amateur results from professional results. The pros, they obsess over this cost because they know it's a silent killer of their profits. Getting a handle on this is one of the biggest steps you can take to protect your money and actually improve your returns over the long haul. So let's get right into it and meet the main villain of this story. It's called the bid-ask spread. And you can basically think of it as the market's built-in fee for doing business. Okay, so here's how it works. At any given moment, every stock really has two prices. You've got the bid, that's the highest price someone out there is willing to pay for it right now. And then you have the ask, that's the lowest price someone is willing to sell it for. The space between those two numbers is the spread. And when you buy instantly, you're paying that higher ask price. When you sell instantly, you get the lower bid price. That little difference is the cost you pay for the convenience of trading immediately. And this brings us to the most common way people trade, and unfortunately, also the most potentially expensive way, the market order. A market order is you basically shouting into a crowded room, "I'll take whatever price you've got." You're absolutely guaranteed to get the shares, no question. But you give up all, and I mean all, control over the price. This throws the door wide open for a really nasty surprise called slippage, which is just the difference between the price you thought you were getting and the price you actually paid. And slippage isn't just one simple thing. It's kind of like a monster with three heads. First, there's price slippage. That's when you're chasing a price that's already moved on, like running after a bus that's already pulling away from the curb. Then you've got liquidity slippage. This happens when your order is too big and you basically eat up all the shares at the best price, forcing you to pay more for the next ones available. And finally, execution slippage is just simple tech delay. Any one of these can mean you end up paying way more than you planned. This quote really just says it all. A market order is a friend of speed, but a foe of price. Yeah, you get your trade done in a flash, but you often pay a big premium for that speed. So if that's the problem, what's the solution? Well, let's introduce the hero of our story, the limit order. This is the tool that puts all the control right back in your hands. With a limit order, you name your price. You're telling the market, look, I'm happy to buy this stock, but only if I can get it for X dollars or less. The trade will only execute on your terms or not at all. This gives you absolute certainty on the price you'll pay. Now, the big fear is always, well, if I set a specific price, my order's never going to get filled. But you have to see this. A landmark study by Professor Venkataraman found something absolutely incredible. Patient retail investors, that's people like us, who use limit orders actually get them filled about 65% of the time. Now compare that to the whole market, which is dominated by these huge institutional traders. Their fill rate is less than 3%. So how is this possible? What's the secret? It's simple. Patience. Retail investors tend to leave their orders open for 20 minutes, maybe up to an hour, letting the market come to their price. And just by doing this, you can save between 10 and 20 basis points on every single trade. Over a year, that is not a small savings. That's a significant boost to your bottom line, all because you kept that money in your pocket. Okay, so we've established that how you place your order is absolutely critical. But for real mastery, you also need to understand when to trade and how to use some more advanced tools to protect your money. It turns out bid-ask spreads follow a really predictable pattern. Every single day, they form a U-shape. Spreads are widest and most expensive right at the market open and again at the close, when all the volatility is happening. But they're at their absolute tightest and cheapest during that midday lull. So the simple takeaway, if you can, try to place your trades between 11:30 a.m. and 2 p.m. Eastern. That's your sweet spot for saving money. And whatever you do, please be extremely careful trading outside of regular hours. The lack of buyers and sellers means spreads can just explode. We're talking an average of 144% wider and sometimes a lot more. Using a market order during these times is basically financial suicide. Now, let's talk safety nets, because this is where a lot of people get confused. Think of a standard stop order as an eject button.
It gets you out of a bad situation, but it's a rough landing. Because as soon as it's triggered, it becomes a market order, which can expose you to huge slippage in a crash. A stop limit order, on the other hand, is like an eject button with a parachute. It triggers at your stop price, but then it becomes a limit order, making sure you don't sell for a catastrophic price. The trade-off? If the price drops too fast, your parachute might not open. The order may not get filled.
Okay, let's put this all together. Here's a simple framework you can use to decide which order to use and when. So here's a quick mental checklist. A market order? Only use it for super liquid stocks during the middle of the day when speed is everything. For almost everything else, make the limit order your go-to, your default setting. Got a big news event or earnings report coming up? That's when you use a stop limit order for protection against a bad surprise. And finally, if you're writing a winning stock, a trailing stop is your best friend for locking in those profits automatically while still letting it run. So if you take one thing away from all this, let it be this. Execution isn't just about clicking a button. It's strategy. How you enter and exit a trade is just as crucial as which stock you pick. By being patient and precise, you can stop paying that hidden tax and start turning smart execution into your own personal edge. The only question left is, what will your strategy be?